Hey everyone, welcome back to Corporate Decoder, the place where we decode corporate filings so you don't have to. Today we're diving into the latest report from Cedar Realty Trust. Let's just say, after looking at this filing, you might want to be extra careful where you park your shopping cart. You'll see why soon enough. This report gives us a peek into how Cedar Realty Trust, a company that owns and runs shopping centres mainly in the Northeast, performed in the first 3 months of this year. It's like checking the health of your local mall owner. Are they making money, or are things looking a little empty? We'll break down the key numbers and see what's really going on behind those storefronts. And if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below for more discussion. First, a quick heads up. Like all these filings, this report contains what are called forward-looking statements. Basically, these are educated guesses about the future. The company is saying, we think this might happen, but things could change, and reality might look different. It's important to keep that in mind as we go through this. Now on to the nitty-gritty. This is a Form 10Q, which is a quarterly report companies file with the Securities and Exchange Commission, or SEC. It's like a report card giving investors an update on how things are going. This one covers the period ending March 31, 2025. Let's dive into the numbers starting with the balance sheet. This is a snapshot of what the company owns, which is their assets, and what it owes, which is their liabilities at a specific point in time. It's like taking inventory. Real estate net is the value of Cedar Realty's properties after taking into account depreciation, which is how much value those buildings lose over time. Here, it's about $172.2 million at the end of last year. This decrease suggests they've sold some properties or that their properties have lost some value. Cash and cash equivalents tells us how much readily available money the company has. It dropped quite a bit from $23.1 million just 3 months. That's a pretty big dip and something we'll want to keep an eye on. Looking at the other side of the balance sheet, loans payable net shows how much debt the company has. It also decreased from $143 million to $134 million. This decrease in debt coupled with decrease in cash and real estate indicates that they might have been selling assets to pay down their debt and their cash levels have taken a hit. Preferred stock also dropped significantly from nearly $140 million to $107 million. This means the company bought back some of its preferred shares, which can be a way to return value to shareholders and simplify the company's structure. Next up is the income statement, also known as Statement of Operations. This shows how much money the company made and spent over the last 3 months. Rental revenues are how much money Cedar Realty made from renting out its properties. That figure dropped from $8.7 million. A smaller rental revenue means less income coming in, which can be a problem if expenses stay the same. Operating, maintenance, and management expenses show how much it costs to run their properties. That figure is at $1.9 million. Less money in, but less money going out could mean they are getting more efficient. We will have to check the margins and see. A gain on sales of $2.4 million is a sign of an asset sale that could help reduce debt. Interest expense net is how much the company paid in interest on its debts. Here it's about $2 million. And now we have what is probably not ideal, a loss on loan prepayment of over $700,000. You have to pay a penalty for getting out of your loan, which is often due to either poor planning or a good offer in hand. The net income is the bottom line, how much money the company actually made after all the expenses are paid. Here, it's a positive $1.4 million. However, take it with a grain of salt since this figure had a gain on sales of assets baked in. They paid $1.9 million in preferred stock dividends. Finally, we get to net income for common shareholders, 9 times $8 million, which is much better compared to a loss of $2 of a positive impact from sales of assets. Now we switch over to the statement of cash flows, which tracks the movement of cash both in and out of the company for a period of time. As mentioned before, their net income is $1.4 million. Again, the gain on sales comes up since this is a non-cash event. Its impact on the metric is a reduction of over $2.4 million. This makes sense as accounting rules mandate that income be adjusted for gains on sale since it doesn't truly reflect operational cash generation. Depreciation adds about $2 million, reversing the earlier deduction and reflecting the cash this accounting technique is hiding. Net cash from operating activities shows the cash generated or used by the company's core business operations. It's a positive $230.30 frictions. Expenditures for real estate improvements of $0.5 million shows money spent on improving the real estate assets. Net proceeds from sales of real estate shows $16.7 million. Loan principal payments represents $9.2 million. They spent $21.22 million to repurchase stock. The net decrease in cash is $14.5 million. Here's a look at their debts. Their fixed rate term loans with an average interest of 5.6% account for over $136 million. Their principal payments are manageable in the near term with under $300,000 for the next 2 years. Moving on, the commitments and contingencies section can tell us about potential future issues or obligations. Here it mentions they are named in a litigation. Preferred stockholders are alleging that the former directors of the company breached their duties to the company's preferred stockholders through the merger of the company. The company has a contractual obligation to help the former directors. Looking at shareholders' equity, in particular to their preferred stock, they had around $34 million Series B preferred stock and $72 million Series C preferred stock in March. They had authorized a stock repurchase program in August. Diving into their revenues and receivables, they have over $4 million in unbilled straight-line rent, which is included in receivables net. Their revenues are mostly from operating lease income, amounting to over $5 million. Now, let's examine their segment reporting, which is basically how the company breaks down its business for analysis. The report states that the chief executive officer looks at each property individually. Because all the properties are similar, they're lumped into one reportable segment. Revenue for the segment is nearly $7.5 million. Their net operating income is around $4.3 million. The report mentions transactions with related parties, specifically with Wheeler Real Estate Investment Trust, which manages their properties and to whom they owe over $9.5 million. This is a key risk factor and thing to keep in mind as the company's financial success relies on its parents to be successful as well. Lastly, we have subsequent events, which is anything that happened after the quarter ended but before the report was filed. They declared dividends for both Series B and C of their preferred stock. They also entered a bridge loan agreement with KeyBank National for $10 million Artapoi. So what's the big picture here? After reviewing the details, I'd say Cedar Realty Trust is at a crossroads. While they're showing a net income, a lot of that comes from selling off assets. You can only sell assets so many times, and without an increase in revenues, they will eventually need to look elsewhere, probably to taking on more debt. A major concern is the significant drop in cash reserves. They really have to manage their cash flow carefully or things could get tight. On a brighter note, their debt levels are declining and their preferred stock repurchase program seems to be reducing future dividend obligations. The related party transactions with Wheeler also add a layer of complexity and potential risk and will likely need to be solved sooner rather than later as these transactions aren't indicative of operational strength. For now, I'd be watching this company closely. Keep an eye on those revenues and make sure they can backfill any gaps left by properties they've sold off. Alright, that's our breakdown of Cedar Realty Trust's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.